Hey everyone, welcome to our channel. Today, we're diving into the exciting world of stock market predictions for 2025. We'll explore what top analysts are saying about the year ahead and compare these forecasts with the remarkable performance we've seen in 2024. So, let's jump right in. The stock market in 2024 saw remarkable growth, with the Nasdaq Composite crossing the 20,000-point threshold for the first time, driven by strong performances in the tech sector and optimism about economic conditions. Now, let's turn our attention to 2025. Wall Street analysts have provided a range of forecasts for the S&P 500, reflecting differing views on economic growth, corporate earnings, and market conditions. Let's examine the key projections from the 2025 year-end forecasts. Oppenheimer's John Stoltzfus presents the most optimistic view, with a 2025 year-end target of 7,100 for the S&P 500. This forecast represents approximately 17% growth and is based on expectations of strong economic growth, broadening of the AI trade, and supportive monetary policy. Wells Fargo follows closely with a target of 7,007, projecting about 16% growth. Their bullish stance is supported by anticipated Federal Reserve rate cuts and a robust economy. Deutsche Bank and Yardeni both predict 7,000, expecting continued bull market momentum. Several institutions offer more moderate forecasts. BMO's Brian Belsky targets 6,700, anticipating a cyclical bull rally and broad-based earnings growth. Bank of America and Barclays/RBC project 6,666 and 6,600 respectively, with expectations of large-cap value stocks leading gains and strong tech earnings growth. Goldman Sachs provides the most conservative forecast among the group, with a target of 6,500. This projection is based on expectations of moderate earnings growth, 11%, stable GDP, and controlled inflation. Analysts highlight several factors influencing their 2025 projections. Economic growth is a key driver, with expectations of GDP growth around 2.5% supporting positive market outlooks. Inflation control is another important factor, with predictions of inflation easing to approximately 2.4%, aligning with the Federal Reserve's targets. Federal Reserve policy is expected to play a crucial role. Many analysts anticipate rate cuts in 2025, which could significantly boost market sentiment and support equity valuations. Lower interest rates typically make stocks more attractive compared to fixed income investments, potentially driving more capital into the equity markets. Corporate earnings growth is also expected to be a key driver. While projections suggest more moderate increases compared to the robust growth seen in 2024, steady and sustainable earnings growth could provide a solid foundation for market gains. Lastly, continued innovation in AI and other technologies is expected to drive market enthusiasm. The tech sector's ability to create new products and services, improve efficiency, and open up new markets could continue to fuel investor optimism. Despite the generally positive outlook, analysts note potential headwinds for 2025. One significant factor is the current high valuations. Price-to-earnings ratios are above historical averages for many stocks, which could limit upside potential. If earnings growth doesn't keep pace with these lofty valuations, we might see some market corrections. Geopolitical uncertainties also loom large. Global events, from trade tensions to regional conflicts, could impact market stability. Investors will need to stay informed about international developments and their potential effects on various sectors and companies. Sector rotation is another factor to consider. As the economic cycle progresses, we might see investors shifting their focus from growth stocks to value stocks or from one sector to another. This could lead to changes in market leadership and affect overall index performance. Regulatory changes, particularly in the tech sector, could also influence market dynamics. As governments worldwide grapple with the growing influence of big tech companies and the rapid advancement of AI, we might see new regulations that could affect market trends. It's worth noting that some analysts, like Tom Lee from Fundstrat, predict a year of two halves for 2025. They foresee a strong rally in the first half of the year, potentially pushing the S&P 500 to 7,000 by mid-year. However, they anticipate a possible cooling off in the second half, with the index settling around 6,600 by year-end. This pattern is based on historical trends following 2 consecutive years of 20% plus gains, which we've seen in 2023 and 2024. As we look ahead to 2025, it's important to remember that these are forecasts, not guarantees. The market promises to be interesting, potentially offering solid growth but with a different character than the explosive rally of 2024. While the overall outlook is positive, it's tempered with caution and an acknowledgement of potential challenges. For investors, this means staying vigilant and adaptable. Diversification remains key, perhaps more so than ever as we potentially move into a phase of broader market participation. A long-term perspective is also crucial. While short-term fluctuations can be nerve-wracking, historically, the market has rewarded patient investors who can weather volatility. It's also a good time to reassess your risk tolerance and investment goals. If you've seen significant gains in recent years, 2025 might be an opportunity to rebalance your portfolio and ensure it aligns with your long-term objectives. Keep in mind that while analyst predictions can provide valuable insights, they're not infallible. It's always wise to do your own research and make investment decisions based on your individual circumstances and goals. As we approach 2025, it's an exciting time in the markets. Whether we see continued strong growth or a more moderate pace, there will likely be opportunities for savvy investors. Stay informed, stay diversified, and stay focused on your long-term financial objectives. Thanks for watching. If you found this helpful, don't forget to like and subscribe for more market insights. See you in the next video.